Welcome back. You're watching Stock Watch with me, Zinati Guma, and joining me to take your stock-related questions tonight in studio, Jordan Toy from Legacy Family Wealth, and via Zoom, David Shapiro from Sasfin Securities. Please be sure to send your questions on email at stockwatch@bdtv.co.za or via SMS on 41392 or on X using the hashtag StockWatch. Thank you so much for your time, gents. David, do not be disheartened at the fact that you did not get an invite into studio. You are still very, very important and valuable to us. All right. Well, it's been quite an interesting day. Interest rate cuts coming from the South African Reserve Bank and also a lot of company news. Let's actually start off there quickly with the SARB's decision today and really just the tone that came from Lesotho Kganyago. Was the tone expected? Because I do understand the 25 basis point cut was expected. Maybe some people would have liked 50 basis points. Was the tone expected though?
So I think you spot on in that the 25 basis points was largely priced in. I think anything outside of that would have been quite a surprise to markets. I do think, as you mentioned, that there was maybe some scope to consider a 50 basis point cut. But I think our Reserve Bank's quite conservative and is not prone to knee-jerk reactions or anything like that. So I think it's a prudent approach and quite well communicated. The tone less clear. My personal view is I think often we tend to be more biased to slightly more hawkish kind of tone coming out of the Reserve Bank. And it's a difficult balancing act. It's not a job that I envy him for. I think it's a very difficult balancing act, balancing growth against inflation. So I think, a decent call today and largely expected though. Yeah.
I mean, also another thing for me, I think when I read the statement, I thought that the Reserve Bank governor was wrong in some way. When you spoke about a risk to a shift in higher global interest rates, David, were you not surprised by any of the statements that came out of there?
He's talking about the Trump trade, which is going to take a long time to come through. He's not even in power yet. By the time he implements all the tax cuts and tariff issues, those that are scaring the market, it's going to take some time. I don't think the Fed is bothered by it. It just continues along its own path. I think the only thing about the Reserve Bank that's a bit concerning, they're down to about, 7.75 now, and they believe that the neutral rate is 7.5. That's only another 25 points. So your neutral rate is you take the rate and you minus inflation. Yeah. So that to me is a bit worrying because even if you look at these rates, we've got an overdraft rate of 11.25. No company can survive borrowing money at that level. So there's no move to actually try and get rates down. If we're going to be stuck with a 11.5 prime rate, it's going to be very difficult for corporate South Africa to grow, or certainly to grow on borrowings and that. So, and then also the outlook for the next 4 years still remains very low. We're only going to hit 2% by 2027. That's our growth rate. Hello. What can you do with 1.25% growth or 1.8? Yeah. Very, very difficult.
All right. I have a very, very cheeky email coming here from a Stockwatch viewer. By the way, I do love our Stockwatch viewers. They are very spicy and very cheeky. The headline is USA state capture. It's a very long comment just to ask a question on the S&P 500, an ETF. Now that President Musk and his dodgy orange sidekick are crossing the T's and dotting the I's on USA state capture, has anyone considered his reign could last 12 years? Just wondering whether they'll also have to deal with the last decade. In their case, cranking up sovereign debt into the stratosphere through tax cuts to the rich and siphoning all useful capital into their respective crypto Ponzi schemes. I, for one, just dumped my S&P 500 ETF. Okay, we're talking about the Trump trade. Yep. And I mean, that's also based on a stronger US economy. Should you be dumping your S&P 500 ETF at this point, Jordan?
Look, I think it's always quite a bold call because you're making a call on market timing there.
Yes.
You're saying that the market's run too hard and it's time to exit. And I think there's lots of periods where we can look historically and say, this was a time to exit, and then the market continues to run. So a bold call. We'll see how it plays out going forward. I think, especially something like the S&P 500, where it's a broad-based index that's quite diverse, a big mixture of companies, I think that's something that you can potentially look to hold in the longer term, and not something that you maybe need to jump in and out of. That's not to say that exiting now might work out for this individual.
Yeah.
But yes, a very bold call. And I think more broadly speaking, the markets, especially with the Trump trade, have run a bit ahead of themselves. And I think in that question they mentioned the ballooning fiscal deficit.
Yes.
But Kamala Harris also had no plans to really address that either. So I don't think that's necessarily something we can pin on Trump. Maybe he will cause a bit more of an increase in the deficit. But I do think that the markets are a bit stretched. You've seen a little bit of wind coming out of the sort of Trump trade over the last couple of days, but history will tell whether that's a good call or not.
Wind coming out of Nvidia as well, and I mean, just talking about an S&P 500 ETF here, David. Of course, including Nvidia, we did have Nvidia results coming out last night. Quite interesting because we did see still revenue almost doubling. Higher than expectations, but it seems that there was some concern because we did see a dip in their shares. So dumping S&P 500 while you still have Nvidia. Talk to me about that.
No, you're crazy. This is going to go up. I mean, it's the strongest market in the world. It's going to dominate for another decade. I mean, when you look at the American companies, I mean, when you look at Nvidia's results, the absolute results, I mean, they're staggering. To start worrying about the margins and issues which are of no concern that only analysts with their CFAs concern themselves with about, trying to work out earnings and margins to the second decimal point. We missed the story, and this is still a very strong story that's going to continue. Get rid of Nvidia, you're getting rid of AI. So I think the S&P is going to dominate. Forget about US debt. As long as I've been alive, and I promise you I've been alive for a long time, everybody's been concerned about US debt. Yeah. So just stop worrying about things you don't understand and just stay with the S&P. I think it's going to be the market of choice, certainly for the next 5 to 10 years.
All right. Okay. There's a question on 91. Okay, the internet was failing me there a little bit, but it's back. 91 for the long term. I bought 91 at 41 Rand 85. Should I keep or sell now? It's below that. I think it's at around 37 right now. And considering the results that we've seen, Jordan, and also the deals with Sanlam. Obviously buying at a higher price than it is now. What would be your take?
Look, I think the news or the current events to focus on, at least in terms of what could be in the near future for 91 is obviously the transaction you mentioned with Sanlam. There's a lot of steps that still have to be done correctly before that deal. I think they came out yesterday and said that they're just taking a lot of an abundance of caution or something along those lines to say, look, we're getting well in advance of this and just communicating very clearly what our intentions are. But there's a lot of regulatory approval, shareholder approval. So there's a lot that's got to happen for that transaction to get through. Having said that, if it does, I think it's around 400 billion in extra assets under management that they could acquire through that. That is somewhat significant to 91 and will obviously ultimately feed through into their revenues and bottom line. But that's almost an event-driven strategy. You're taking a view on, do I think this deal is going to go through or not? And that's a whole different facet of investing on its own. So a tricky one to call just purely based on that. I think you've got to try and look through that and look at the fundamentals of the company. I think it's quite a well-run company. We as
so whether the deal happens or not.
Personally, I quite like 91 as whether the deal occurs or not. We deal with them quite frequently as investment managers. We have some client funds there as well as at other asset managers as well. And I think quite a well-run company, aside from the funds that they run and the performance of those, but the company itself, I'm quite positive on.
Okay, well, a second question on that, David. So as a client of Sanlam, I receive a message that 91 will be managing certain of their investments. Why should I not just transfer my investments directly from Sanlam to 91 and cut out the middleman? David?
Well, there is no middleman.
Yeah,
You know,
because
the middle is 91. It's actually a very ominous sign and a very concerning and worrying sign about the state of the South African market. That Sanlam should actually abandon its asset management team and say, okay, we're just going to focus on underwriting. In other words, going out there, selling policies, managing pension funds and so on, and leave the running of the investment side to 91. You know, Sanlam, if you go back, a number of years back to the 80s and 90s, and that there was Old Mutual, Sanlam, Liberty, and Alan Gray. And if you didn't deal with them, you couldn't survive in the industry. And after that came a lot of the pension funds, PIC, Mine Officials Pension Fund, and so on. So, I mean, this was a major player, an absolute major player there that is just kind of turning its back on its asset managers. And there's going to be attrition. You know, otherwise they wouldn't do it. Meaning attrition is that they're not just going to send their staff over there and saying, okay, run it for 91. Of course, it's going to be double counting in order to save costs. So I think look at this, and it also tells you about the state of the underlying JSE, you know, that the opportunities are running out. But from that point of view, where it goes to from now, I don't know. Asset managers, 91, will prosper when you go into big boom markets. You know, when people are feeling rich, when an economy is growing and you're going to buy products, you've got more savings to go into that. You know, at the moment they've got 4 savings in it.
Yeah.
So and also when markets go up very strong, you make profits from, you know, because you're getting higher assets under management, you can charge more. You've got you know, you can make profits, whatever it is. I don't know, the whole fee base. So you need a very strong underlying economy to drive those kind of businesses.
Yeah.
But at the moment, we're all stealing business from each other. You know, I go to Legacy Wealth, I try to get their clients, they come to us, they try to get our clients. You know, that's what it is. There's a certain pie. It's not increasing.
Talking about the economic growth dynamics and taking lunch from each other, I want to talk about Mr. Price. They spoke about low economic growth that's still impacting their numbers, but also market share gains on that front. David, what did you think of that? And particularly looking at the share price momentum of Mr. Price that just does not seem to be slowing down.
That's interesting, because when I first looked through the numbers this morning, I thought, okay, a little disappointing, didn't quite meet or match our view on their sales, and yet they were up 7-8% today. So, but if you look, Zanati, if you look across the market, all the retailers went up.
Yeah.
And I think it was more a move around buying retailers than specifically on their numbers. And even so, even if you read the commentary, it's not, it's not over encouraging. Things are still pretty tough out there. My only fear is that I think a lot of these stocks are outrunning their numbers. You know, somewhere along the line, the numbers are going to have to catch up. But, you know, while we're partying, just enjoy it. But I still think that going through all the results today, you know, along the line, there were all warnings about, you know, the underlying economy. There wasn't anybody who just said, oh, things are really great. Yes. You know, even City Lodge, still kind of veiled warnings.
Your take,
so, anyway.
Yeah, it was actually up more than 8% actually on the day.
Okay.
Crazy. Jordan, your take on Mr. Price?
No, I think David's spot on. I think I also looked at the share price movement relative to the actual results and thought it's exactly like David thought. It's reasonable results, but 8%, maybe not.
Yes.
But I think, and David summed it up perfectly there, is I think across the board, City Lodge, I think Truewords a little while ago, Mr. Price, there's always a line in the commentary talking about, you know, the consumer remains under pressure kind of
Even
story.
Lewis.
Exactly. Yeah. And I think a lot of these results are up until, say, end of September. So you're not seeing, I know we've talked about two-pot extensively, but I think it's especially relevant for the retailers. And everyone's expecting this, you know, to feed through to earnings for some of these companies.
Yeah.
That remains to be seen. And I think some of their commentary has also touched on that to say, well, you know, we're expecting that things will maybe start to turn and there's optimism around the GNU, but kind of when is that going to happen? We're waiting.
Although it was interesting because I think I saw in one or two saying that there's been strong trading from September. Yep. So it's going to be quite interesting. And you look at September, and that was the month of two-pot, And obviously after the stats that we got yesterday from SARS talking about 35 billion already that's been withdrawn, we're hoping that it's going to filter through.
Zanati, you know, just on that.
Yeah.
Zanati, just on retail, we're coming up for Black Friday, which has always been one of those periods where people just go a bit tilt, you know, and start by. I'm not seeing the bargains. You know, I'm not seeing them come through in any big way. They might be at the low end of the market on the foodstuffs, you know, on special things, but I think it's also a reflection of what's out there. It's, you know, everybody's waiting to see if they can pick up bargains. And the fact that they're not, there's just a bit of a concerning sign. I don't know whether they're concerned about money not being there and, you know, putting themselves out or companies putting themselves out for this, but it just doesn't seem the same as it has in previous years. Yeah, I might be able to buy cheap Coca-Cola or something like that, but that Stanley Cup that you've got, that's not that.
I'm also looking for furniture, and I really have not seen any significant deals. I mean, one of the sectors where definitely Two-Pot is going to go into is restaurants. Famous brands. There's a question here. Ask the panel about the merits of an investment in famous brands at this point in time. Jordan, yeah, in particular famous brands, because it's quite interesting because, I mean, it's a competition between them and Spur. Yeah. And they've seemed to be the underperformer. But of course, a high tide lifts all boats. So merits, are there any?
Look, I think famous brands, it's been around for a long time. And you know, there's a lot of brand value in some of the brands that they do own. I mean, you know, you talk about Wimpy, Steers, like there's some, but there's been a lot of ups and downs along the road as well. If we look historically at the share price, and I think, as you said, that, you know, maybe Spurs pulled ahead for quite some time now. But as you said, you know, interest rate cuts are happening. Does a rising tide lift all ships? Yeah. I think to a degree, yes. I think there's still some work to be done. You know, I think some of those brands have still got some extra effort that's needed to sort of revitalize them. Yeah. But in the long term, you know, there's also some value there, maybe relative to Spur, that you know, that you're not getting if you're looking at Spur. So you need a view on the medium to long term, but I think it's not so clear cut.
Yeah, and actually, David, that's the thing, because it has been an underperformer. Maybe famous brand stands to have the most upside from the more positive environment. What do you think?
I think it's going to be a very interesting holiday period. Remember where these brands have come from. In COVID, they were in real trouble. Yeah. You know, they still had to keep their restaurants going. And then out of COVID, you come with all the issues of load shedding and other issues that just kept them from prospering as well. And then you have inflation, which they couldn't pass on. Yeah. You know, they couldn't pass on the increasing costs of meat and chicken and everything like that. So they've had a rough time, and they had to kind of cut back on their margin. So it's going to be interesting. I can't jump to conclusions. I can't read what's going to happen, but we'll see afterwards how they managed over the holiday period, whether they were able to, you know, lift their margins, get the crowds back. I think they very well run, and I think they give incredibly good value for what you pay. But once more, it depends on how much money people have got and how much they ask Jordan, where does he hang out? Where's his offices?
We don't want people to start going to where Jordan hangs out now, David, please.
Because I do the test here. You know, I'm in Sandton, I'm in Melrose Arch, I'm in Bluebird. We're in, you know, all these places, and I'm checking out what the holiday crowds are, how much people are spending. I haven't seen, you know, a lot of holiday, I mean, kind of, you know, the year-end spirit yet. Yeah. So I always look at this and see, okay, what are people spending? What they're eating? Are there big parties? It just doesn't seem to be. It seems a little subdued at the moment. That's why I'm asking Jordan where his offices are. Is he a Bryanston boy?
Yeah, but you know where I hang out, because you and I, David, have bumped into each other in Melrose.
Yeah, I know. Tasha's Melrose Arch still doing well.
Yeah, I don't
Except you're always there with another man. That's the only problem. I never get to know their names.
Well, on the same line of thought, Bidcorp. Please ask the panel for a 3 to 5 year view on Bidcorp. I mean, Bidcorp is one that never seems to be having a hard time. or is that just my perception?
Look, I think they've got, a very different story to Famous Brands.
Yeah.
A lot more international,
Yeah.
so a lot less focus on South Africa. And maybe that's, to your point, a large part of the reason why things have been a little bit more stable. And as you say, they seem to just plod along and never seem to shoot the lights out, but just steady as it goes. I like Bidcorp as a business. I think they've got quite a diverse international presence.
Yes.
They are in that same space, however. So, certainly took a knock during COVID and since then, recovery, but interest rates always help. So same with Famous Brands, right? If you're under less pressure as a consumer, and granted, UK consumers or international consumers are not in the same shape that South African consumers are, but I think, reduced interest rates always helps to sort of lift that burden, and maybe that translates to more people eating out, which is obviously, they're not running restaurants, but they have a heavy involvement in that space. So, so one I like.
All right. Your sentiments on Bidcorp, David?
Look, it's a very solid business, very well run. It needs critical mass. I'm looking at Nvidia's margins; they're over 70%. A business that kind of delivers sugar to a restaurant, you can't actually charge 70% on things like that. So you've got to understand the basis of that business. But they're very, very good in what they do, and you're going to get just solid, decent returns over time. Well run, came out of the Bidcorp stable, Bidvest stable. There are a lot of legacy management, good shape. So it's one of the better South African companies, better companies on the in the SA market, and it is international. So I like it.
All right, just trying to find out how much time we have to see if I can take in one. Oh no, we don't have time, but. Good news for the viewers, we do have Stockwatch tomorrow as well. Let's get to your stock picks. Jordan, what are you picking today?
I wanted to talk about Stryker Corp today. It's a US-listed company in the medical field. So they specialize they've got a number of different areas, but primarily orthopedics, medical equipment, stuff of that nature. Aside from it being sort of a well-run company, the share price speaks for itself. It's done very well. But in the longer term is something I also like. We look at themes, very long-term themes around global average age. And if we look at, we talk about Japan and specific countries, but in general, we are seeing people are living longer. And that ultimately, our view is that benefits healthcare companies and medical companies on the margins. But aside from that, Stryker is a good business, in my opinion, and continues to go from strength to strength. So, yeah.
All right. David, on your side, what are you hanging your hat on?
I like Stryker. They replace your knees as you get older and things like that. Right. I'm also going for internet. I'm going for Walmart. And what we're finding, Zanati, is that people are buying down. They're no longer buying recognized brands. And we misunderstand just the kind of pressure that consumers are under. And you would have seen it in the election. The Democrats never got that right. So you look at Costco and Walmart. I thought Target, but Target came out with very poor results. But it's more on the food side that people are buying down, buying home brands. And Walmart came out with really good results. And I think this trend is going to continue. So if you want to take advantage of lower rates, I would prefer to go for the low-cost retailers like Walmart and Costco, more so than going for what traditionally we would go for, like the manufacturers or consumer staple companies. All
right. Well, thanks so much for your time and for your analysis today, gents. Really, really fun and insightful show there. That is all for tonight's edition of Stockwatch. Thanks to our guest, Jordan Toy from Legacy Family Wealth and David Shapiro from Sasfin Securities. Up next, The Close. Stay tuned.